If there's anyone who knows how to pick stocks, it's Peter Lynch. While managing the Magellan Fund at Fidelity Investments between 1977 and 1990, Lynch grew the fund's assets from $18 million to $14 billion, making it the best performing mutual fund in the world. Since then, he's built a $450 million net worth and has cemented himself as one of the most successful and well-known investors of all time. Fortunately, most of Lynch's investment techniques aren't too complex or difficult to learn, even for beginners. Stay tuned to find out how you can pick stocks like Peter Lynch. Only buy what you understand. If you've listened to Peter Lynch before, you must be familiar with his popular mantra, know what you own and know why you own it. He also shared this simple but effective investment lesson in his bestseller, One Up on Wall Street. According to Lynch, average investors are more likely to succeed and see bigger profits if they stick with companies they understand. He says, buy only what you understand, believe in, and intend to stick with, even when others are chasing the next miracle. In another famous saying, the legendary investor reminds people, the worst thing you can do is invest in companies you know nothing about. Unfortunately, buying stocks on ignorance is still a popular American pastime. Lynch compares investing in stocks to other skills like ice skating or playing the cello. It's smarter to understand it first and then try it. If you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going to try it. But people are buying stocks anyway, he explained. When asked about what his advice would be for such people, Lynch replied, if you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less, you don't own it. Buy in your industry, buy what you know, buy local companies. Therefore, if you plan on investing in individual stocks, make sure to understand each company those stocks represent before you go ahead with your investment plan. Develop a plan of action and proactively determine where you are in the investment cycle, what your goals are, and how you plan on reaching them. Make sure you understand your investment strategy, and in case you don't feel qualified to do this, you can always hire a trustworthy financial advisor or planner. Always do your homework. In case you didn't know, smart and diligent research was a cornerstone of Peter Lynch's success. According to him, investing without research is like playing stud poker and never looking at the cards. One of his other quotes from One Up on Wall Street further emphasizes the importance of research. It says, average investors can become experts in their own field and can pick winning stocks as effectively as Wall Street professionals by just doing a little research. In his book, Lynch has specifically highlighted how you can research stocks on your own by learning a few investment metrics. The first one is percentage of sales, which states that before investing in a company solely based on a product or service that attracts you, make sure that it comprises a high enough percentage of sales to be valuable. The next concept is the price-to-earnings growth ratio, or PEG ratio. This tells the expected earnings growth, so you'd want to look for companies with a stronger PEG ratio. Similarly, do your research about which companies have strong cash positions and below-average debt-to-equity ratios. Diversify your portfolio. This is another investing principle that's repeatedly followed by the world's most successful investors. To put it simply, diversifying your portfolio means spreading your investment dollars around, in terms of industries, company size, and growth potential. When your portfolio has a variety of assets, it stays stable even when one or more assets take a hit. Peter Lynch has always been a firm believer in diversification, which is why his Magellan Fund had more than 1,000 individual stock positions. This is approximately 5 times the number held by an average mutual fund. According to Lynch, your portfolio should not only be diversified, but also valuable, meaning that it should consist of the best possible stocks you can buy. Here are his exact words. There's no use diversifying into unknown companies just for the sake of diversity. A foolish diversity is the hobgoblin of small investors. That said, it isn't safe to just own one stock, because in spite of your best efforts, the one you choose might be the victim of unforeseen circumstances. In small portfolios, I'd be comfortable owning between 3 and 10 stocks. Invest for the long run. Successful investors don't waste their time worrying about short-term details. Instead, they think long-term and stay focused on what's far ahead in the future. They picture growth in a matter of years and even decades, because they understand that building long-lasting wealth through investment takes time. As Lynch says, an important key to investing is to remember that stocks are not lottery tickets. He also said, absent a lot of surprises, stocks are relatively predictable over 10 to 20 years. As to whether they're going to be higher or lower in 2 or 3 years, you may as well flip a coin to decide. Lynch believes that trying to time the market or predict the direction of the overall economy and its short-term fluctuations isn't worth the effort. Instead, an investor should stay focused on long-term goals and stop chasing temporary returns. Lynch reinforces this concept in a powerful saying: "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." That's all for today, guys. We'll see you in the next video. Until then, take care and goodbye.